Macroeconomics for Investors. Chapter 9, Commodities. Section 1, Commodity Market Overview. A good becomes a commodity when one unit is close enough to another unit that buyers and sellers can treat them as interchangeable. That quality is called fungibility, and it is what allows large markets to function smoothly without every trade turning into a custom inspection. A barrel of oil, an ounce of gold, or a bushel of wheat can be traded confidently if the market agrees on grade, purity, or other standards. Without that standardization, pricing would be far less transparent and trading would be slower and more expensive. This is why commodity markets tend to focus on basic goods rather than unique products. Investors should remember that the market is not buying any oil or any wheat, but a clearly defined standard version of that good. Commodities are often divided into hard and soft categories, and that distinction helps explain why their prices behave differently. Hard commodities are mined or extracted, so their supply depends on geology, drilling, mining investment, and infrastructure. Oil, natural gas, copper, and gold all fit this group. Soft commodities are grown or raised, so their supply depends more on weather, disease, planting decisions, and harvest timing. Corn, soybeans, coffee, cattle, and cotton are all examples. For investors, this means the same broad idea of supply and demand applies to both groups, but the actual drivers can be very different. At the broadest level, commodity prices rise when supply tightens relative to demand and fall when supply grows faster than demand. In practice, several forces usually hit the market at once. A drought can reduce crop yields, a pipeline outage can restrict energy flows, or a policy change can alter trade patterns almost overnight. Transportation problems matter because even when a commodity exists in the world, it still has to reach the right buyer at the right time. Currency moves also matter, especially the US dollar, because most global commodities are priced in dollars. When the dollar strengthens, commodities often become more expensive for non-US buyers, which can soften demand. Standardization is one of the main reasons modern commodity markets are liquid and useful. Exchanges define exactly what a contract represents, including quality, quantity, delivery month, and delivery location. That means participants do not need to renegotiate the basic terms every time they trade. It also reduces disputes because everyone is working from the same contract specifications. Some contracts allow for physical delivery, while others may settle in cash, but in both cases the rules are clearly spelled out. For hedgers and investors alike, this structure makes commodity markets far more accessible than a world of one-off private deals. Commodity trading happens in two linked markets, the spot market and the futures market. The spot market is for immediate or near immediate delivery, so it reflects the value of the physical good right now. Futures markets, by contrast, let participants agree today on a price for delivery at a later date. That makes futures useful for hedging because a producer or buyer can reduce uncertainty before the physical transaction happens. It also makes futures useful for speculators who want exposure to price movements without handling the commodity itself. In fact, most futures contracts are closed before expiration, so many participants never take or make delivery at all. Futures markets are central to price discovery because they absorb new information very quickly. A weather forecast, an inventory report, or a geopolitical headline can move futures prices within seconds. Those futures prices then help guide transactions in the physical market, since many spot deals are negotiated with reference to exchange prices. In that sense, futures markets are not separate from the real economy. They are part of how the real economy forms prices. This matters for investors because watching futures often gives an earlier read on market expectations than waiting for physical transactions alone. Commodity prices are continuously updated estimates of supply, demand, and risk as new information arrives. Spot and futures prices are related, but they are not always the same because time has an economic cost. Holding a commodity involves storage, insurance, and financing, and those carrying costs often push futures prices above spot prices. When futures are above spot, the market is said to be in contango. When futures are below spot, the market is in backwardation, which often happens when nearby supply is especially tight. For investors, this distinction matters because returns from a futures-based strategy depend not only on the commodity's price direction, but also on the shape of the futures curve. That is one reason a commodity ETF can perform differently from what a simple spot price chart might suggest. Commodity markets bring together participants with very different goals. Hedgers use the market to reduce business risk, not to make directional bets. A farmer may want to lock in a selling price, a miner may want to protect revenue, and an airline may want to control fuel costs. Speculators do the opposite. They willingly take price risk because they believe they can profit from it. Both groups matter because hedgers create demand for protection and speculators often provide the liquidity that makes trading easier. A healthy commodity market depends on that transfer of risk between commercial users and financial participants. A simple corn hedge shows what hedging is really trying to do. Suppose a farmer expects to sell 10 W000 bushels and sells futures at $5.50 per bushel to protect that price. If the spot price later falls to $4.80, the farmer's cash sale brings in only $48 W000, but the futures position gains 70 cents per bushel, which adds another $7,000. Together, that produces an effective revenue of $55,000, close to the target the farmer was trying to protect. The key lesson is that hedging is about reducing uncertainty, not maximizing the best possible outcome. Here, commodities differ from stocks and bonds because they do not generate cash flow on their own. A stock can pay dividends and benefit from earnings growth, and a bond can pay interest and return principal at maturity. A commodity, by contrast, mainly offers returns through price changes. That can make commodities useful as diversifiers, especially when inflation or supply shocks hurt traditional assets. But it also means commodity investing comes with distinct risks, including high volatility, boom-bust cycles, and roll costs in futures-based products. Investors should think of commodities as a different tool in a portfolio, not as a direct substitute for equities or bonds. Section 2. Energy commodities. Energy commodities matter because they sit near the core of modern economic activity. Crude oil, natural gas, gasoline, and heating oil feed transportation, electricity generation, home heating, and industrial production. When these markets tighten, the effects spread quickly through the broader economy. Energy prices also react strongly to bottlenecks because production, storage, pipelines, tankers, and refining all have physical limits. A small disruption can produce a large price move when inventories are already low or spare capacity is limited. For investors, that makes energy one of the most macro-sensitive and headline-driven parts of the commodity complex. Crude oil is not a single uniform substance, and that is important for pricing. Lighter crude tends to be easier to refine into valuable fuels, such as gasoline and diesel. Sweet crude, which has lower sulfur content, requires less processing than sour crude. Because of that, refiners often place a higher value on lighter and sweeter grades. Price differences between crude benchmarks are therefore not just about supply and demand in the abstract, but also about quality and refinery usefulness. When investors compare oil prices, they need to remember that 2 barrels of crude can carry different economic value. Brent and WTI are both major crude benchmarks, but they are shaped by different market structures. WTI is the main U.S. benchmark and is tied to delivery at Cushing, Oklahoma, an inland hub where pipeline and storage conditions can matter a lot. Brent is more closely connected to seaborne trade, and therefore reflects broader global market access. That is why the two prices can diverge even when both are tracking crude oil. The Brent-WTI spread reflects not only quality differences, but also logistics and the ease of reaching global buyers. For investors, treating them as interchangeable can lead to bad conclusions about what the oil market is really signaling. Natural gas behaves differently from oil because it is often more regional, more infrastructure dependent, and more sensitive to weather. In the United States, Henry Hub is the main benchmark, and short-term price moves are heavily influenced by heating demand in winter and power demand in summer. Storage matters enormously because gas supply and demand must be balanced through the seasons. Pipelines matter too, since gas cannot always move freely from one region to another. This is why gas prices can swing sharply even when the global oil market is relatively calm. For investors, natural gas requires paying close attention to weather, inventories, and regional bottlenecks, rather than assuming it will simply follow crude. Gas storage reports move prices because markets care about surprises, not just raw numbers. Each week, Traders compare the actual change in inventories with what they expected and with seasonal norms. If the report shows a larger than expected draw, that usually signals tighter supply and can be bullish for prices. If it shows a larger than expected build, that usually points to looser conditions and can be bearish. The report also gains meaning from context, such as whether inventories are already low versus the 5-year average. So when you watch natural gas react to a Thursday storage release, the key question is not simply what happened, but whether it was tighter or looser than the market had priced in. Gasoline and heating oil are refined products, so their prices depend on more than crude oil alone. Gasoline demand typically rises in the summer driving season, while heating oil demand tends to peak in winter. At the same time, refineries often schedule maintenance in spring and fall, which can temporarily reduce output. That means refined fuel prices can rise even when crude is relatively stable. Investors sometimes miss this and assume all fuel prices should mirror the oil benchmark tick for tick. In reality, the refining system adds another layer of seasonality and constraint that can meaningfully shape returns. The crack spread is a useful concept because it links crude oil prices to the value of the fuels made from crude. In simple terms, it compares the refinery's input cost with the value of the output products, such as gasoline and distillates. When the crack spread widens, refining margins are generally improving. That can happen because fuel demand is strong, because refinery capacity is tight, or because crude prices are falling faster than product prices. When the spread narrows, refiners face more pressure. For investors, the crack spread helps explain why refinery-related companies and fuel prices may move differently from crude itself. Energy markets are volatile because the underlying physical system cannot adjust quickly. Storage is limited, production takes time to ramp up or shut down, and pipelines, terminals, tankers, and refineries can all become bottlenecks. Weather can disrupt both supply and demand at the same time, as with hurricanes or winter freezes. Geopolitical events add another layer because prices may rise on fear of future disruption even before actual supply is lost. That risk premium is a real part of energy pricing. For investors, this means energy is a market where relatively small physical disruptions can create disproportionately large financial moves. In practice, energy prices are formed through a chain that runs from extraction to processing to benchmark pricing and then into futures markets. Producers pull crude oil and natural gas out of the ground. Refiners turn crude into usable fuels, and benchmark locations such as Cushing or Henry Hub help anchor contract prices. Futures on exchanges like NYMEX and ICE then translate all of that physical reality into tradable prices. Even if most traders close contracts before delivery, the delivery terms still matter because they define what the contract actually represents. Inventory data from EIA and API constantly reshape expectations along the way. This is why energy pricing is never just about one headline number. It is about the interaction between physical flows, benchmark points, contracts, and surprises. Weather shocks can spread through multiple energy markets at once. A severe cold wave can sharply increase natural gas demand for heating, just as storage is being drawn down faster than normal. At the same time, freeze-offs can reduce gas production, tightening the market from both directions. That combination can support Henry Hub prices very quickly. Heating oil may strengthen too as households and businesses look for alternative heating fuels. If oil production is also disrupted by the same weather event, crude prices can react as well, which shows how one shock can ripple across related energy markets rather than staying contained in a single contract. A common mistake in energy investing is to look at one move and assume the whole complex should behave the same way. Brent and WTI are related, but they are not interchangeable benchmarks. Natural gas and oil can sometimes move together, but often they are driven by very different fundamentals. Refinery outages and maintenance can change gasoline and heating oil prices even when crude is steady. One storage report can matter, but it should not outweigh the broader seasonal and inventory picture. And a seasonal price pattern is not the same as a lasting structural change. So context is essential before drawing conclusions. Section 3. Precious metals. A metal is considered precious not just because it is rare, but because that rarity combines with durability and distinct forms of demand. Gold, silver, platinum, and palladium all resist corrosion and hold value well over time, which makes them useful beyond ordinary industrial metals. But they are not precious for the same reasons in the same proportions. Some demand is monetary or investment driven, some comes from jewelry, and some is tied to industrial use. That mixed demand profile gives precious metals a market character that sits somewhere between a financial asset and a raw material. For investors, the category is useful, but the metals inside it should not be treated as identical. Gold stands apart because its role as a store of wealth matters more than its industrial use. It has a long history as money, reserve collateral, and a hedge against financial stress, which is why central banks and investors both hold it. Industrial demand exists, but it is relatively small compared with gold's monetary role. That is why gold often trades more like a financial asset than like a metal used in manufacturing. It can attract interest during periods of inflation concern, market instability, or currency weakness. Still, investors should avoid assuming gold rises in every crisis because the broader financial backdrop, especially interest rates, also matters. Silver sits between gold and the industrial metals, which gives it a more mixed personality. It shares some monetary history with gold, and investors do buy it as a precious metal. But a larger share of silver demand comes from industry, including electronics, solar panels, and some medical uses. That means silver can benefit when both industrial activity and investor demand are strong at the same time. It also means silver often behaves more cyclically than gold and can fall harder in economic downturns. For investors, silver may offer more upside in some expansions, but it usually comes with more volatility. Platinum and palladium are precious metals, but their prices are driven mainly by industrial demand rather than reserve demand. One of their most important uses is in catalytic converters, which ties them closely to the auto sector. That makes global vehicle production, emissions rules, and engine mix major price drivers. If one metal becomes too expensive relative to the other, manufacturers may try to substitute between them where technically possible. This substitution can shift demand and alter price relationships quickly. Compared with gold, these metals are much more exposed to the business cycle and much less tied to monetary sentiment. Supply concentration is especially important for platinum and palladium because a small number of countries dominate global production. South Africa is a major source of platinum, and Russia is a major source of palladium. That means strikes, electricity shortages, sanctions, or export restrictions can move prices sharply. When supply is concentrated, the market has less flexibility to absorb disruption. Even if demand has not changed much, the fear of interrupted output can create major volatility. For investors, this is a reminder that in some metals, geopolitical and operational risk can matter just as much as broad macroeconomic conditions. Several forces influence precious metals, but their weight differs by metal. For gold, real interest rates are often the most important driver because gold does not pay income, so it becomes more or less attractive depending on the return available on safe financial assets after inflation. A stronger US dollar can also pressure prices since dollar-priced metals become more expensive for foreign buyers. Inflation matters too, but often through its effect on real yields rather than as a simple one-to-one relationship. Silver, platinum, and palladium are more exposed to industrial demand, so manufacturing activity and sector-specific conditions play a larger role. That is why the phrase precious metals can hide very different underlying drivers. Investors can gain precious metals exposure in several ways, and each comes with trade-offs. Buying bullion bars or coins provides direct ownership of the metal, which appeals to people who want a tangible asset. ETFs make access much easier by offering liquid exposure through a brokerage account. Futures and options add another layer, allowing hedging and speculation with less capital upfront but much more complexity. The best choice depends on what the investor actually wants: possession, convenience, liquidity, or tactical flexibility. In other words, choosing the vehicle is almost as important as choosing the metal itself. Physical metal ownership gives direct possession, but that comes with practical costs that are easy to underestimate. The buyer often pays spot price plus a dealer premium, and there may also be storage, insurance, shipping, and resale spread costs. An ETF avoids many of those burdens and makes trading simpler and faster. But in an ETF, the investor owns fund exposure rather than holding coins or bars personally. That means relying on custodians, fund operations, and ongoing expense ratios. For investors, the trade-off is straightforward. Physical metal offers direct control, while ETFs usually offer far greater convenience. Spot and futures markets work together in precious metals, just as they do in other commodities. The spot price reflects immediate delivery, while the futures price reflects delivery at a later date and may include financing, storage, and insurance effects. Futures are especially useful for commercial users who want to reduce price uncertainty before they buy or sell metal in the physical market. A jewelry manufacturer, for example, can use gold futures to help lock in a future purchase price. Most futures positions are closed before delivery, but the daily margin system and delivery terms still anchor the market. For investors, futures are powerful tools, but they require understanding leverage, margin, and how price discovery actually works. Consider a jewelry manufacturer that expects to need 500 ounces of gold in the future. By buying 5 gold futures contracts now, the firm can offset part of the risk that gold becomes more expensive before the physical purchase. If the spot price later rises, the company pays more in the cash market, but the futures position gains value and cushions the increase. The hedge is not perfect, and it does not remove every source of risk, but it reduces uncertainty around input costs. For investors, the broader lesson is to match the tool to the risk you want to manage. Physical holdings, ETFs, and futures each solve different problems, and precious metals themselves should not be treated as one uniform asset class. Section 4. Agricultural Commodities. Agricultural commodities are raw materials produced through farming and livestock rather than mining or extraction. They are often grouped into grains, softs, and livestock, with examples such as corn, coffee, and cattle. Unlike many industrial goods, agricultural supply depends on living systems, which means biology and seasonality matter a great deal. Planting, growing, and harvest cycles shape when supply becomes available. That makes these commodities renewable over time, but not instantly adjustable in the short run. For investors, agriculture is a reminder that renewable does not mean stable. The major agricultural groups help organize the market, but each one behaves differently. Grains and oilseeds such as corn, soybeans, and wheat are shaped by acreage, yields, storage, and export demand. Softs like coffee, sugar, and cotton depend more on weather zones, harvest quality, and transport conditions. Livestock markets, including cattle and hogs, are influenced by feed costs, herd cycles, and disease risk. These categories are useful for building intuition, but they should not encourage oversimplification. A bullish story for corn may tell you very little about coffee, and a move in cattle may have little in common with either one. Agricultural supply is unstable because it depends on forces humans can influence only partly and slowly. Weather can reduce yields, delay harvests, or damage transport routes at exactly the wrong time. Disease can hurt both crops and livestock, cutting supply unexpectedly. Biological growth also takes time, so farmers cannot respond to a sudden price move as quickly as a factory might increase production. That is why agricultural markets often react sharply to changing conditions, even though the products themselves are renewed every season. In the short run, the farm economy is much less flexible than many investors first assume. Seasonality is one of the most important patterns in agricultural markets. Because crops follow annual production cycles, supply tends to become more available around harvest, which can put downward pressure on prices. Before harvest, uncertainty is usually higher because the final crop size is still unknown. During the growing season, especially in the summer for U.S. grains, weather can move prices very sharply as markets react to changing yield expectations. This creates recurring seasonal tendencies, though not mechanical guarantees. Investors should use seasonality as context, not as a shortcut that replaces actual supply and demand analysis. Short-run agricultural demand is often relatively steady because food and feed consumption does not change dramatically just because prices move. People still eat and livestock still need feed, so demand tends to be pricey and elastic in the near term. That helps explain why relatively small supply changes can create large price swings. Over longer periods, though, broader forces matter more. Population growth, rising incomes, diet shifts, biofuel policies, and trade policy can all reshape demand in a meaningful way. For investors, the key contrast is that short-run demand is often stable, while long-run demand can still evolve quite a lot. Storage and perishability are central to agricultural pricing, because not all products can wait for a better market equally well. Corn and wheat can often be stored for months, which gives sellers some flexibility in timing. Livestock has a narrower marketing window since animals keep growing and feeding costs continue. Some soft commodities also face quality risks in storage or transport, such as moisture damage or deterioration. These differences affect carrying costs, basis behavior, and how futures relate to physical prices. For investors, a storable grain market and a more perishable agricultural market can behave very differently even if both belong to the same broad asset class. Futures contracts help agricultural producers and buyers transfer price risk before the physical transaction occurs. Because contracts standardize quantity, quality, delivery terms, and delivery months, they create a clear tool for hedging. A producer can sell futures to protect against falling prices before harvest. A buyer, such as a food company, can buy futures to protect against rising input costs before purchase. In both cases, the contract does not remove every risk, but it can reduce uncertainty around revenue or costs. This risk transfer function is one of the main reasons futures markets are so important in agriculture. A short hedge helps a producer reduce the risk of lower prices at harvest. Suppose a corn farmer expects to harvest 50 REL-O bushels in October, and each CBOT corn contract covers 5,000,000 bushels. Selling 10 December futures contracts gives the farmer a hedge roughly matched to expected output. If cash prices fall by harvest, the farmer receives less in the cash market, but the futures position gains value. Those futures gains help offset the cash loss and bring the effective sale price closer to the original target. It is not a perfect lock because basis can move, but it is a practical way to reduce downside price risk. A long hedge works in the opposite direction for a buyer. Imagine a coffee roaster that expects to need about 551 W1 pounds of coffee later and buys 15 May futures contracts to cover most of that need. If coffee prices rise before the physical purchase, the company pays more in the cash market, but the long futures position should gain value as prices rise, helping offset that higher cost. In effect, the roaster is using futures to preserve margins by reducing exposure to an adverse input price move. This is a good reminder that hedging is useful on both sides of the market, not just for producers. Even a well-designed hedge is not perfect because of basis risk. Cash prices and futures prices usually move together, but they do not always move by exactly the same amount. Local quality differences, transportation issues, and the choice of delivery month can all affect the final outcome. A hedge using the wrong contract month may reduce risk less effectively than one that matches the timing of the physical transaction more closely. So the goal is not perfection, but a better fit. Investors and commercial users alike should understand that hedging reduces uncertainty more than it eliminates it. Agricultural markets punish oversimplification. Ignoring seasonality can lead to bad timing decisions, especially around planting and harvest cycles. Treating all agricultural markets as if they respond to the same drivers misses major differences between grains, livestock, and soft commodities. Forgetting storage costs, carry, and perishability can also distort how you interpret prices and futures curves. And it is a mistake to view speculators only as noise, because they often provide liquidity that helps hedgers trade efficiently. In agriculture, the details of timing, contract fit, and commodity-specific fundamentals matter a great deal. Section 5. Commodities and inflation. Commodities are closely linked to inflation because they sit near the start of the production chain. Oil, metals, and crops are basic inputs into transportation, manufacturing, food production, and many consumer goods. When their prices rise, those higher costs can work their way through the economy and eventually affect what households pay. Because of this position upstream, commodity prices often move earlier than broader inflation measures. They can reflect emerging cost pressure before it fully shows up in consumer price indexes. For investors, commodities can therefore offer an early signal that inflation pressures are building. Commodities are often described as a partial inflation hedge because they are real assets tied to physical demand. Unlike cash, which loses purchasing power when prices rise, commodities can sometimes hold value better during inflationary periods. They are used in production and consumption, so higher inflation often coincides with higher prices for at least some raw materials. But the word partial is important. Commodity performance varies widely across sectors and over time, and they do not provide perfect protection for a portfolio. They can help in some inflation environments, but they should not be treated as a guaranteed shield. The relationship between commodities and inflation runs in two directions. First, higher commodity prices can help push inflation higher by raising input, energy, transport, and food costs. Oil is especially important because it affects so many parts of the economy directly and indirectly. Second, inflation fears can bring investor money into commodities as people look for real assets that may hold value better than cash or nominal bonds. So commodities are not only causes of inflation pressure, they can also become destinations for capital during inflation scares. That two-way relationship is one reason commodity markets can move so quickly when the inflation narrative changes. Commodity prices can rise before inflation peaks because markets are forward-looking. If producers expect higher costs, some of those costs are passed through before the full inflation effect appears in consumer data. Investors may also buy commodities and related assets when they expect inflation to rise, which reinforces the move. Futures markets speed this process up by pricing expectations quickly rather than waiting for lagging economic reports. But this mechanism can also reverse when central banks tighten policy. Higher interest rates, a stronger currency, and weaker growth expectations can interrupt the inflation hedge story even while inflation itself is still elevated. Not every commodity rally is a sign of broad inflation. Sometimes many commodities rise together because the whole economy is experiencing broad price pressure. Other times only one sector jumps because of a specific disruption, such as war, production cuts, drought, or disease. Oil can spike on geopolitical risk even if other commodities are calm. Agricultural prices can surge because of weather even when there is no economy-wide inflation shock. For investors, the key question is breadth. Are many commodities moving, or just one? That distinction helps separate an inflation signal from a sector-specific supply problem. This distinction matters because the same price move can imply very different portfolio decisions. A broad, inflation-driven rise across commodities may support the case for diversified commodity exposure as part of an inflation response. A narrow, supply-driven move may be much more isolated and may reverse if the disruption fades. In other words, one sharp move in oil does not necessarily mean the whole commodity complex should be bought as an inflation hedge. Investors need to understand the cause before acting on the signal. Context should come before allocation. The early 2021 inflation surge offers a useful example of commodities performing well during a broader inflation shock. As economies reopened and supply chains remained strained, inflation moved higher and several major commodities rose with it. U.S. inflation climbed to around 5%, crude oil rose from roughly $60 to $85, and copper also posted strong gains. In that kind of environment, a broad commodity ETF could deliver meaningful positive returns, such as turning $10,000 into about $12,400. The lesson is not that commodities always outperform during inflation, but that they can respond strongly when inflation pressure is tied to real-world supply and demand constraints. The hedge can reverse quickly because commodity markets look ahead. If central banks begin signaling rate hikes, or if investors start expecting weaker growth, commodities can come under pressure even before inflation fully cools. Slower growth implies weaker demand, and tighter policy often strengthens the currency and reduces speculative enthusiasm. That means an inflation-sensitive commodity ETF that previously performed well can fall sharply, even while headline inflation remains high. This is why commodity exposure is often a tactical or partial hedge rather than a stable long-term solution. Inflation protection in commodities can be real, but it is often temporary and path-dependent. Using commodities for inflation protection involves several risks that investors should keep in mind. Not all commodities hedge inflation in the same way, because gold, oil, and wheat respond to different drivers. Implementation also matters, since physical exposure can involve storage costs and futures-based exposure can suffer from roll costs or negative carry. Commodities are useful diversifiers, but they are not replacements for equities, which remain central for long-term growth. Another common mistake is adding a large position only after prices have already spiked, which can leave the portfolio exposed to reversal. A disciplined rebalancing process is often more effective than chasing an inflation theme late. A measured response usually makes more sense than a dramatic shift when inflation rises. The starting point should be risk tolerance, because commodities are generally more volatile than a traditional stock bond mix. Investors also need to decide whether they want broad commodity exposure or a narrower bet on a particular sector, such as energy or metals. In many cases, a modest allocation can add diversification and some inflation sensitivity without overwhelming the portfolio. That approach preserves the role of core holdings while recognizing that inflation regimes can change. For most investors, the goal is not to go all in on commodities, but to add them carefully and proportionally.